I'm Charlotte McLeod with investingnews.com, and here today with me is David Erfle, editor and founder of Junior Miner Junky. Thank you so much for being here. Great to have you.
Thanks again for having me on, Charlotte. Nice to see you again as well.
Really good to be speaking with you. And we're catching up after PDAC when we had a quite brief conversation. I think this one will be able to go into a little more depth. And of course, where we're going to start is with gold. So if we look back to that PDAC time when we were speaking, that was at the beginning of March. And I think we can really trace this breakout in gold back to almost that exact point in time. So I wanted to take a look back at gold over these almost 2 months at this point and ask you about its performance. Has it surprised you during that time?
Well, the severity of the move upwards has really not surprised me, because I've been expecting a breakout for a really long time above that 2100 level. That was the Maginot line of resistance, right? For 4 years, that 2100 level, just gold kept running up there and falling as soon as it got there. But it created this huge base as it was doing so. So whenever you have a breakout of a large base, the breakout move can run rather fast. I mean, the move really started in the middle of February when gold tested 2,000 for the last time. And then gold went up in round numbers about $450 in 2 months since then. So, and in the middle of that, we had that major breakout. So the move higher, it remained overbought for a really long time. That wasn't really surprising considering the catalysts basically for the move. We had geopolitical and macroeconomic catalysts happening at the same time. So that wasn't really surprising, no.
Okay. Thank you for going into that. And I'm hoping we can talk a little bit more about catalysts for gold right now. I've heard a lot of different ideas about what caused that gold breakout. And I'm wondering, I guess, what you're watching right now. What are the main factors that you're paying attention to for gold at the moment?
Yeah, well, the gold price started to break out on macroeconomic reasons. And then when the Middle East powder keg started to explode, that's when gold really started to bust a move higher, and it nearly reached 2,500. So now, after 4 consecutive weeks of closing above its weekly upper Bollinger Band, the Bollinger Band is an algorithm designed to keep the price of something within bands 95% of the time, lower and upper bands. So gold closing above its weekly Bollinger Band for 4 consecutive weeks, there was a 99% chance, technically, of the gold price having a correction this week. And it started right away on Monday as Middle East tensions pretty much calmed down. So now the market is pretty much focusing on the macroeconomic again, because we got the PCE data, inflation data, coming out on Friday. And that's the Fed's preferred target, right? And at the same time, we've got the Federal Reserve on a blackout period before the next Federal Reserve meeting, which is next Wednesday. And towards the end of last year, there were jawboning rate cuts, up to 6 rate cuts by 2025 and 3 rate cuts this year. Well, now they've walked that back all the way to possibly no rate cuts. So the uncertainty that's going on, the market realizing that the Fed's between a rock and a hard place, the debt situation, the geopolitical situation, all these things are factoring into the gold price now. So I expect it to remain pretty volatile here. When we get that PCE data on Friday, depending on how the market accepts it or doesn't accept it, or comes to the conclusion that, hey, it's going to be higher for longer, even longer, the dollar, which is consolidating around 105, which was a former resistance. Now it's creating a bull flag here to possibly go to 107. Now the gold price and the dollar have been going up together as a safe haven because of what's happening in the Middle East. So will the PCE data coming in hotter than expected, which most everybody's expecting here, will keep the Fed, higher for longer. Higher interest rates is a big drag on this economy, and the stock market is starting to crack because of that. So will gold focus on that? Will the Middle East flare up again? There's a lot of things going on here. So, but gold can actually correct all the way down to 2,200 even. It's corrected down to 2,300 already. It could correct down to 23 and 2,200 and still be in an uptrend. So gold's got a lot going for it right now. And the stock market there's a lot of uncertainty in the stock market. There's a lot of uncertainty in Fed policy. So I'm really not concerned about the gold price. I'm more concerned about when the gold stocks are going to finally start to react like they historically react and show a 2 to 3 times leverage in the gold price, which they failed to do thus far.
Thus far. Okay. And we're definitely going to come back to the gold stocks. But just before we go there, we're talking about the Fed and these interest rate cut expectations, which have been steadily reducing from where we were kind of at the end of last year, as you mentioned. So I'm wondering, why have we seen that economic strength in the U.S.? Why has that continued? Because I think that's kind of what's behind these pushing out of the interest rate cuts.
Well, a lot of it is short covering, right? You see shorts start to short the stock market ahead of economics of U.S. economic data coming out. The data comes out strong, and they have to cover. So a lot of this has been short covering, and a lot of it has been AI stocks continuing to go higher. And now we're starting to see cracks in AI stocks. Tesla's already broken down a while ago. Apple started to break down. Microsoft has started to break down. So people are starting to figure out, hey, maybe I should take some of these profits off the table. So, but the U.S. economy is still the strongest economy in the world, and it makes up 25% of the global economy. But basically, all of our growth has come from debt. I mean, since 2008, all U.S. debt, that's governments, federal government, state, municipal, and corporate debt, and household, even and consumer debt, it's all grown almost 95%, the debt. So, just the federal debt alone has gone up over 200%. So, the market's starting to realize that, hey, this debt will never be able to be paid off. It's gonna have it's basically gonna have to be inflated away. So, but the U.S. isn't really in a position like they were in 2008 when they recapitalized all the banks to try to inflate away all the debt. There's just it's becoming too much of an issue. So that's what the gold price is sensing, is that the Fed is stuck, and they basically can't be trusted in what they say anymore, because they went back and in late last year they started saying that, hey, we're going to cut interest rates, and now they're saying, no, we can't cut interest rates because inflation is remaining higher for longer, and the market's starting to figure out that, hey, when the Fed finally does have to cut rates, they're going to have to do it with rising inflation, and that's stagflation time, and that brings back memories of the 70s. So all these issues, gold is sniffing out all of this, and that's why I continue to believe that gold is still going to go a lot higher. I mean, based on history, it's about to really take off after a major breakout.
Yeah, and that is one of the questions I had in mind to ask you, is if what we're seeing right now can be looked at, historically in comparison to another era. So it sounds like yes.
Yes, absolutely. I mean, the gold bull market that started at the turn of the century in 2001, what really kicked it off was Alan Greenspan coming out during on the first trading day of 2001, calling an emergency meeting and doing a 50 basis point rate cut. And every time the gold has had these major up legs, it's coincided with the stock market going into a bear market. And within the, we saw the gold price from 2001 to 2005 double from 250 to 500. And then we had a consolidation period for a couple years. And then we saw the gold price double again after the consolidation was over from 500 to 1,000. We saw another consolidation for a few years. We had the the great financial crisis in 2008, where it knocked gold back down to below 700. But then the gold price doubled again from 1,000 to nearly 2,000 in a couple of years again. So I have no reason to believe that it won't happen again here. So that means that, will we see a gold price upwards of $4,000 in a couple of years? I don't see why not.
All right. And you've mentioned, I think, many factors that are adding to these tumultuous times. And I'm gonna throw in one more, which is we're in an election year for the US. So does that have bearing on what's happening?
Yes, it absolutely does. And you bringing that up is interesting because in the U.S. here, we've had, this is, we're the world's largest superpower, and we entered uncharted territory last Monday, when for the first time in history, a former president is being tried in a court of law. And this is happening during an election year, and most everybody is concerned about this because they see it as being highly political. Donald Trump is leading in several polls to be the GOP candidate. So if he's put on trial in New York now, and there's 3 other trials after this that he's got to go through, he can't campaign, and if he's actually put in jail before the election, I mean, the potential for civil unrest is just, unfortunately, really, really out there. So the gold price is sniffing out all of this as well. If you take a look at what's happened with this election, it's really unfortunate how the two sides are becoming farther and farther and farther apart. And then, once the election is over, I don't see the other half really accepting the victor, just like what's happened during the last 2 elections. But this one could be even more heated because, like I said, I mean, the leading candidate might be in jail by the time it happens. And it's going to be really interesting how it's going to unfold. But I don't think it's going to get lost on the gold price. That's for sure.
Yeah, I think we already got a taste of that unrest at the last 2 elections, like you said. So that would definitely be something to keep an eye on. And I'm sure we won't be able to get away from watching that if we wanted to. So keep an eye on that. Going back to gold, one more question on the gold price. So you mentioned 4,000 as, I think more of a longer term level for gold. In 2024, I think people are wondering what's the potential this year. So what are you seeing?
Well, it's already hit its first. It broke out of a technical pattern, the most bullish technical pattern in technical analysis, which is a cup and handle pattern, and it was a 13-year cup and handle, which it's broken out of. And the first target was 2,500. We pretty much reached that target when gold hit 2450 a couple of weeks ago. So after a period of consolidation, $3,000 is the next target. It's also, a psychological round number. So I wouldn't be surprised to see a $3,000 reached at some point this year. But also you need to take a look at the silver price, because the silver price is finally, to a certain extent, it's started to play catch up here to the gold price. But its major Maginot Line resistance has been $30 an ounce for the past 40. And it can't get over $30 an ounce. It tested it again recently, a couple weeks ago, and fell sharply back down again. So I think once you get the silver price breaking out above 30, I think that will really get the bull market going in gold, and especially in gold stocks. And we also need to see the gold-silver ratio trending below 80. It's about 85 right now. So even though the silver price has started to take off, it's still showing relative weakness to the gold price, although it is starting to trend lower, but it needs to trend lower below 80 to 1 before we really get, I think, some movement in the gold stocks in relation to the gold price, because they're still massively undervalued in relation to gold.
Okay. So for silver, that $30 level is key. And what do you think pushes it over the edge? Because it's very teasing. It gets very close and then it goes away.
Well, I think going back to what I mentioned before about the Federal Reserve being forced to lower rates, because I've been saying for the past several months that I don't think the Fed is going to lower rates until they're forced to. And being forced to means the stock market really starting to crack and go lower. The S&P getting below 4,900 and really starting to move lower during an election year. I think there'd be a lot of political pressure for the Fed to lower rates despite inflation being so high, continue and well above its fantasy 2% target. So I think when that happens, that's when silver really takes off.
Okay. And so, of course, it all ends up being connected. Okay. So I will let you go back to what's going on with the gold stocks. So this is really important, and it's a topic that we also spoke about during that early March conversation. We talked about the disconnect and how people are, of course, not very happy to see the gold price at such historically high levels and their gold stocks not necessarily responding. So are we seeing any signs there that this is going to change?
Yeah, we are. We're seeing several signs. We're seeing both gold and gold stocks started to outperform the stock market right as we came into Q2, and the gold price was starting to break out above that 2,100 level. That needs to continue, and it needs to accelerate. And I think it will accelerate once the stock market really starts to see more selling and people start to rotate those huge gains that they've had in AI stocks and crypto also. And they start to say, hey, wait a minute, maybe I should put some of these gains into the safety of gold. It's happening in China. In China, there's a huge bull market going on in gold, and it's much stronger than it is here. Because it's being participated by the people as well. There's ETF buying, there's physical buying, there's central bank buying going on in China. So, but that's not happening in the West. Central banks aren't buying as much gold in the West, and the citizens aren't buying gold via ETFs. They are buying at Costco, which you saw that gold at Costco is selling upwards of $200 million a month in gold, in 1 ounce gold bars, but it hasn't really transferred into ETF buying quite yet. I mean, the outflows have ceased and they've started to turn to inflows, but we really need to see investment demand pick up in the West in gold.
Okay, and we're getting to the point where we should start to see the Q1 results from the miners. So I was going to ask, how important do you think that is for the gold stocks and interest in gold?
Yes, that's very important as well, because that margin compression has really hurt the gold stocks a lot. The gold price basically went nowhere for 4 years while inflation raged. So gold averaged, it looks like from what I've seen from production numbers that a lot of these companies have announced already. Gold average, the average price they sold gold for in Q1 was about $2,070, and that's about $100 higher than Q4. So I think the profits are going to be much better, but I think the Q2 profits are going to be even stronger. We're not going to see those results, obviously, for another 3 months. But I think the companies that have low all-in sustaining costs on the lower end of the curve, they're going to report very strong results.
Okay, and good point. Of course, we'll see what the next quarter brings as well, and that will be important. So I just want to also check on your focus right now. So if I'm remembering properly, and I'm probably going to oversimplify this, but I believe you were focused not on the juniors, but on the later stage explorers and developers as well. So is that still where you're at?
Yes, I'm still not concentrating on early stage companies, because there's a lot of these late stage developers and growth and small cap growth oriented producers that have a lot of growth in them. I like those much better because they've already found the ounces and they're less risky. But the problem for a lot of them is raising the capital. A lot of them have to raise more, 3 times more capital than their market cap to start constructing these projects. So I'm concentrating on these companies that have multi-million ounce deposits in safe jurisdictions and the management teams have access to capital, and they haven't blown out their share structure in a bear market while de-risking their projects. Several of them, they looked a lot more attractive a few years ago, but unfortunately they've had to blow out their share structures to de-risk their projects in bear markets. So there's not as many of them that look attractive anymore due to that, as far as, their upside is concerned. What once was 3 to 10 times upside, maybe 1 to 3 times upside now because of the blown out share structures, de-risking projects. So it's very tricky. You have to be super selective on the companies that you speculate on. Still, we haven't had that aha moment where the sector has started to really take off. We've seen several quality issues bifurcate from the sector and start to move higher with the gold price, but as a sector, it still hasn't really broken out yet because we haven't had the interest in the retail market return yet. I mean, they left 12 years ago and they still haven't returned. So we need to get more speculative interest into this sector, especially into the junior space. So until then, it's still a stock picker's market as far as the juniors are concerned.
Right. And I was going to ask, in terms of the juniors, is there a point in this bull cycle where you would say, okay, now I'm going to look at them, or is it really not worth it at this time?
Oh yeah, there'll be a point. Where I'm going to say, okay, it's time to start looking at the more speculative end of the juniors, the more early stage, the ones that have tied up large land packages and they're still in the early stage of defining a resource. There will be a time where I'll come back into those stocks, but that's not here yet.
Okay. We'll keep checking in with you on that one. All right. As we're getting closer to the end here, I wanted to check in with you on some comments you made in one of your recent commentaries on mindset. And you're talking essentially about the importance of switching your mindset from bearish to bullish. And you really have to do that in order to kind of take advantage of these moves. So I thought that would be really useful to go into here.
Yeah, I mean, it's once you had a major breakout in the gold price historically, you've still got a lot of hesitancy in the junior space. The miners take off first, the royalties and the mining companies take off first, and then it trickles down into the juniors. So people that, investors that have had a lot of patience in accumulating stocks during a bear market, they have to continue to have the patience to let their research in these companies and taking a chance and accumulating them when nobody wants them to pay off. Because a lot of investors, and I've been a victim of this in the past, and that's how I learned when I first got into the sector. The switch was flipped, and all most of the juniors started taking off, and I'd been the ultimate contrarian. I was buying fishing lines and I was accumulating these stocks when nobody wanted them, but several of them hadn't taken off yet, and there was other ones that I was watching that were leaving the station and they were really starting to move higher. But I lost patience in some of the ones that I was down on, and I took a loss on some of the ones that hadn't taken off yet, and I chased some of the ones on my watch list, and it turned out to be a big mistake because I basically left a lot of money on the table as well as showing some losses while in a bull market. So that's what I want to caution against. I mean, if you're keeping up with these companies, and selling them should be company specific, not sector specific. Meaning, if the company does something that you feel will be bearish in the long term while the sector is going up, absolutely sell it and get into something else. But if that's not the case, don't sell it just because it hasn't moved yet. That's going to come, once the retail finally gets back into the sector, after leaving 12 years ago, these things are really going to start taking off. I mean, if you take a look at the entire global asset base, gold gold and the gold mining sector is less than 1% of the total global asset space. That's the lowest it's been in over a century. So, once the retail starts to come into these things, they're really going to move quickly, the quality ones anyway. There's still a lot of lifestyle juniors that need to go away that haven't and probably won't. So you have to be very wary of those. That's why I say you have to be very selective in the companies that you're going to hold while this bull market really takes off and gets into the next stage. I mean, we're in the very early stages here. These gold mining cycles, they last about 3 years. We had the first major one of the century was 2001 to 2003. Then we had a consolidation. Then we had another mining cycle from 2005 to 2007, another consolidation. And then the next one was 2009 to 2011. But since then, we've basically been in a depression in the junior sector. We've had a couple of 6-month bull markets followed by 4-year bear markets. And it's really, zapped the life out of this sector. I mean, people not only have forgotten this sector, but a lot of them really hate it. So that sows the seeds for a major bull market coming because, bear markets don't last forever, just like bull markets don't last forever. Like I said, we're seeing a lot of signs that we're coming out of it right now.
That sounds like a really good place to wrap it up, but I'll put it back to you in case you had any final thoughts or if you want to let everybody know where they could find you.
Yeah, sure. I write a column in Kitco. It comes out every Friday. You can find me there, or you can find me on my website, juniorminerjunky.com. And pretty much my last message is, if you've been accumulating stocks and you're very frustrated, like of course myself and a lot of my subscribers and a lot of people in this space, keep your head and make your decisions on buying and selling. Make them company specific with a bull market in mind. Now you can't be bear market thinking anymore. We're now in a bull market, so you have to change your mindset, or else you'll let your emotions get the best of you.
Okay, really good. Thank you so much for coming on to go over what's going on in gold right now and a little bit of silver. This was really good.
It was my pleasure, Charlotte. Always great to talk to you.
Great. And once again, I'm Charlotte McLeod with investingnews.com, and this is David Erfle with Junior Miner Junky. Thank you for watching. If you like this video, make sure you subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below. We'll see you next time.